My guest today is Jesse Tinsley. He's the founder and CEO of a holding company, Job Mobz, which buys and builds recruiting businesses. Jesse has bootstrapped it to a point where its assets are at 200 million. Again, 100% bootstrapped, fascinating stuff. Thanks a lot for coming to the HoldCo Builders podcast, Jesse.
Yeah, thanks for having me on. It's been a long-time fan and excited to talk about some stuff I don't usually share about. So it's gonna be fun.
Let's first start with your background and early days, because this is what often shape us. You started your business in 2012, but you were doing it part-time till 2016. Your main job was being a firefighter. Tell us more about this period. What was the initial idea, early days? And very interesting is also, what was your schedule while doing it all?
Yeah, it's a really good question, and some good background research on your end, because not everyone pulls all that info. So kudos to you. I grew up. Quick version. I grew up in Silicon Valley. I went to school in Los Gatos area, which is a small suburb in Silicon Valley, and went to school with a bunch of folks that worked in tech. It was like normal. I went to school with Steve Wozniak's son, for example, like founder of Apple, and like folks that like seemed normal to me, but obviously to the rest of the world, it's like, oh wow, that's really, really cool, right? So I was around in tech from a young age, pretty much through my entire childhood, and then got into building some businesses in college. And then I was actually a forced entrepreneur. I dropped out of school and couldn't get a job because it was the great financial crisis, and it actually led to me starting Job Mobz and scaling that up. And it seemed not great at the time, but obviously worked out in the end. So it was a lot of fun. But I started doing recruiting as in a young age, so I knew that skill set, and that's when I built Job Mobz to start with, a services business, and then transitioning into buying and holding different software companies, which has been a lot of fun. So the short version.
We can maybe go a bit more into detail. Maybe you can share some stories of how did you get your first clients, and maybe we can even start like, what exactly is a recruiting business? What were you doing when you just started, and maybe how has it changed, and how you manage it doing it all again part-time? Because being a firefighter, it's pretty intense. You probably can't run a business while you are at work.
Yeah.
So
yeah, totally. So yeah, I worked. To touch on the fire piece, I started in the fire career, I guess you call it, job right out of high school. Volunteered for a year or two, and then got hired with Cal Fire, which is like our seasonal fire force here in California. So there's lots of wildfires, and that actually helped me bootstrap my business. So firefighters have a unique schedule where you work 3 days on, or 2 days on, 4 days off. So it allows a lot of time. You have a ton of downtime to actually build a business, which is great. Even at the station, you have downtime where you can go respond to emails and respond to customers, and from a not be on Zoom calls or whatnot, but there's lots of downtime to actually respond and build a business, which is a great way to pay your salary and cover benefits when you're bootstrapping something, right? So, worked, pretty crazy hours for a couple of years, and then, finally, went all in on it to your point in 2016. And, things taken off since then. Recruiting's changed a lot though in the last 10 years, last couple of years even. You're seeing the public, I talk about this a lot online actually, is you're seeing that every services company, especially with AI, right? I think AI in the short term is actually it creates more jobs, and I think in the long term it destroys more jobs, especially in the knowledge sector. And I think that what's going to happen, especially in recruiting, is these recruiting services businesses, they have to become software companies and digitize the modern age, or they will be replaced with software. And so I think that's the shift. And you're seeing that with the large consulting firms like McKinsey, Bain, and Deloitte, and all of them. They're all moving into software components and recurring revenue models, and I think that's going to happen in recruiting pretty heavy. Otherwise, they'll be displaced.
I want to still ask a few questions about the early days before we go into detail. Thinking back, going all in with the business after 4 years, when you look back, do you wish you have done it earlier, or it wasn't possible?
I think it was the right time. There's many factors for doing it at that point in time. I had my first, my wife and I had our first daughter in 2015, and then in 2015, and many other factors. So it was like work-life balance compared to being gone, like, any type of shift work. So like my hat's off to anyone, our military and police and EMS services that basically protect, keep everyone safe while everyone else gets to go home at night. Those folks are on shift 24 hours a day. So it was a few different trade-offs. It was not as easy as a decision at the time. Like a pretty good, like the fire service, I was grandfathered in with like old benefits. You retired at 50 with 90% of your pension. It was not as clear cut as it is today. If somebody would look at me today and say, "Oh man, you built a $200 million plus company, right?" Like that's awesome. But like at the time, my business was not, worth anything. So it was not as clear cut as you might imagine. And I think most people were not super ambitious on my decision. Short of my parents and my wife. So
there are many different models in recruiting firms. For example, direct hire, recruiting as a service, and probably many more. Again, as I don't know much about this industry, when you started, you did something. Now you do something same or else. How has it changed, and what exactly are you doing today?
So how it started, we were doing traditional like contingency search where you do, you hire an engineer, you get paid 20% of the first year's base salary. That's a pretty common traditional recruiting model. We moved into RPO, which is like reoccurring annualized contracts and helping build out entire companies and scale them up. And we've helped scale a lot of companies over the years that were pretty small at the time and went through, huge, became unicorns, like, Coinbase and 23andMe and Scale AI and lots of others. But we would help them in an embedded model and work on site with those founders and teams and help them grow for some duration of time, which was a lot of fun. We got to build a lot of meet a lot of folks in the space and brought in like our network a lot quicker than you would working in-house somewhere. So that was a lot of fun. And then segueing from that, we went and bought a bunch of software companies in the space that now provide recurring revenue. And now we do a lot of payrolling and EOR benefits and stuff like that. That's all software-led growth.
Okay, you already mentioned helping those companies scale AI, Coinbase, Honor. What exactly did you do in those businesses, number one? And as you already mentioned, as I mentioned, there was a tweet you did about these guys and their work ethic. So maybe you can cover those things. What exactly did you do and the intense work ethic those guys had?
So the first, I personally consulted with those companies. So I was early like tech recruiter, in 2013 before I even gone in full time. With 23andMe, and they were, really small at the time, probably less than 40 people, somewhere between 30 and 40 people. And helped also, Scale AI and Coinbase and those companies very early on, Stellar Development Foundation, Protocol Labs and others. But I think the one thing that I was tweeting about is one thing you'll notice with a lot of founders that are highly successful is just a really intense drive and work ethic, right? Like I think, what's a story I can share? I won't mention who, but one of the younger founders of the group of those folks, we worked in the office in San Francisco and you see them responding in Slack at 3, 4 a.m. and then come in the office and come out of a nap room, in the office at 9 a.m. or 10 a.m. Right. So that's pretty common. These founders putting in time. I think, CEOs get a bad rap a lot, publicly, but I think at the end of the day, all of them universally worked extremely hard or very focused hours to basically make sure, their businesses are successful. And that's something that's pretty universal across the board. You can't be half in or partially in or work 40 hours a week and win, I think, in technology, especially now, whenever it's everything's advancing and moving so quickly.
And opportunity-wise, how were you able to land them as a clients? And how did you make it happen?
That is a whole nother discussion, probably be a whole nother podcast. I think you think through the individual specifics. 23andMe, I just reached out. They had just posted this this recruiting opportunity, and I reached out directly to them. Like, there's a contract recruiting opportunity. I reached out, ended up doing a ton of research. I actually wrote like, a personalized, note and a bunch of different stuff, made it very custom. One of the things I'd say, like, and I think a few of these were referrals. I think one of the things I would say though, like, I've always had like really high success rate reaching out to founders. I'll figure out what their problem, like what they're solving for, and I'll reach out. So like if I was trying to reach out to you to come on your podcast, I research you same way you research me, right? And I think I basically do like a custom project. Say, hey, Mick, like I looked at X, Y, and Z, right? And see like you're doing it this way, and I try to solve your problem. And so in recruiting, I would say, hey, I looked at your open jobs. I actually went and I sourced against them, and I made this project. Here's the Google sheet. Like, feel free to use them or reach out to those folks. And here's like 10 people that fit these different buckets, and they're good. Like, I'd find the best profiles of these folks in that area. I mean, like, these ones are awesome. Like they worked at, Stripe, and they worked, went to Harvard or whatever. You give them the top folks. And I'd even put notes for certain folks that I like already was working with that I knew that were like candidates I've known for a while, right? So I was like, hey, I already know these folks. You want an intro? I'm happy to do it. You don't have to pay me anything. Like, just want to help out. Be all good if you hire somebody else. And my response rate on that is 100%. I've never had a founder not respond to me, period. Like, when I do something that custom and I email them, 100% response rate. That usually takes an hour or two of my time or a couple hours, but well worth it because they remember that. Like, even, somebody emails me, I will respond back if somebody builds something that custom, even if it's not, right. It's like, hey, I can't do that, whatever this is, but I really appreciate the time, whatever. You're going to get a response, and you'll stand out in the crowd, whether you're trying to get business or a job or whatever. I think that's a huge, huge advantage. And I think, whenever I post this on social media, I get a ton of blowback. People are like, oh, I don't want to do like free work. Well, at the end of the day, like, you're going to have to work hard to make a name for yourself either way. And I'd rather be at the right company, the right place with the right founder, and that's going to get you to stand out above the thousands of applicants or other people vying for that business. So, and there's lots of stories through like that. Not anyone like specific, but I think like, folks have done the same thing with like, Warren Buffett and Mark Cuban, and like similar stories to that, right? Where they're just writing a cold email, like, or call their office and stuff like that. So it obviously works. I think a lot of folks are just afraid to put in like the effort and send like a boilerplate message and like expect different results, right?
So you provided lots of goodwill upfront, and you helped them by actually helping them.
Yeah, I'm never afraid to put in the work. I think, again, I think that's universally true of any successful founder, whether you're building a HoldCo or just a traditional company. I think there's not many, unless, there's a few founders that probably done it, but I think in a lot of cases they're making money off of the idea of the 4-hour work week and work less so than like the actual like ability to work 4 hours a week. Maybe AI will change that, but maybe in like a couple of years, revisit this podcast. Like it's all not true now with AI, but until that day happens, for now, lots of hard work.
So let's cover a little bit about the timeline to understand how things have been going for you and Job Mobz. You started in 2012, 2016. You went full time. What happened next?
Yeah, it flew by quick. We basically hit a pretty huge like a upswing in like 2018. That's when we landed like Coinbase and some other large customers, Box.com and a few others, like started to expand pretty rapidly. And then like fast forward to COVID, the market was down in 2020, right? And then what would happen, you'd see like the most prolific, like the craziest job market that the history of technology, or maybe the world, from 21 to like beginning of 2022 or mid 2022. And then you see like a complete rapid cool down. So like, in 2022, identified an inflection point in the market. Like you think about like a strategic inflection points, as a founder all the time, right? And there was key, like in May 2022, I thought the music had stopped and everyone was still at the party dancing. And I basically made the decision. We didn't pay out any bonuses in June. We didn't give any pay raises. We completely cut. But this is while all these other companies are still like moving salaries up, paying bonuses, like all the things that you'd expect, which actually really insulated us. We didn't have to do any like forced layoffs or anything like that. Unlike all of our competitors, like they're either dead or they've declined revenue 90% or more in a lot of cases. So that actually strategically set us up for the last 2 years. So you fast forward today, we're able to complete 8 acquisitions. We have another 3 that are moving towards definitive agreements, and going to continue building out that HoldCo. But that wasn't actually something that we planned on doing. I just realized the market had shifted. And I think in 2020, the thing that I missed as a founder was like, where did the market go? And I think we could have made a lot more money coming out of COVID. And so this time I really wanted to identify where the opportunity lied. And I thought it was buying businesses that were pressed multiples, where historically they're trading at 5 to 10x. And we can buy 1 to 2x. And that's what we've done.
I missed this. When was the first acquisition?
You probably couldn't have found it online because it wasn't something we did and publicize. So the first one was like this time 2 years ago, roughly October 2022. And it was a company was divesting out of their services division. So like it was a technology company that actually just no longer wanted to run RPO, which is what we do as a service. And so they just handed it off to us with a rev share. So that's like technically our first like acquisitions, I call it, but it was just free handoff. So it's like fantastic from that perspective. So we just got a rep share on that. And then everything kind of snowballed from there, that inflection point forward, starting like March 2023 with like recruiter.com's first transaction we did with them. And then buying out their services business. And then the rest, I think, were public from that, but I have to go through them. It's interesting.
You have done this great thing that you haven't jumped on different opportunities, different industries. So by 2022, you have this 10 plus years in the industry and you have this market knowledge. So how do you think this has made a difference for you to make those acquisitions? Because you mentioned that you are able to buy those cheaper as your competitors.
Yeah. So a few different things. I think like, we only buy businesses in HR tech or like recruiting space that we know. Like, so we know the businesses inside and out. I can look at like a data room and instantly know in like a few minutes whether I want to buy a business or whether it's something we'd be interested in, or whether it's at a good price, right? I think like similar to like a lot of these businesses, it's not like they're one, really easy to operate from our perspective, and then two, like it matters a lot on like what are the terms of the deal. So we only focus, like we would be outside of our domain to go buy something that's like, I don't know, what would be like a gaming company, right? Like a mobile gaming company. That'd be something like we wouldn't even know how to value it, wouldn't know how to operate it, wouldn't know how to go to market with it. But we know recruiting, we know our customers, like enterprise customers on down, what solutions they're using and how to actually service them from both a product and service perspective. And I think that's been a huge, huge advantage for us. Where we passed, like a lot of the deals we've passed over in the last 2 years have been we've been really glad. And the business we have closed, we've been really like happy to have closed. And I think a lot of that comes with the domain expertise. We see a lot of acquisitions happen in the space by others that are outsiders that never bought or like rarely bought in the space. And like, I think that's where a lot of mistakes happen, where you're outside of your lane. And you're buying things because it looks good on paper, not realizing that the macro trend of that business might be on the decline permanently or, obsolete to some degree within the sector.
I don't know how much you can share, but what about how do you finance those deals and what are the structures? Do you acquire 100%? How much maybe debt you're using? How does it work?
Yeah, so I think like one of the things, like we're Bootstrapped, right? So we're using cash off our balance sheet, we're using owner financing, we're using earnouts, rolled equity, different incentives across the board. We're helping restructure debt in some cases with those banks and not even assuming debt in some cases. So I think we started with like the good comparison would be like, I just learned about this. I'm very proud of myself. I haven't actually studied anyone that did investing, right? It's autodidactic and learning a lot of this. So like, I think like Warren Buffett talked about like the cigar butt strategy of investing. We were doing a lot of that early on, where it's buying distressed businesses and helping like actually revamp and like restructure debt and help basically get that business out of a tough situation. And what's great about that is we actually built a reputation in this sector where now any business that has an issue, whether it be short-term payroll or, their bank's going to call a note on them or whatever it is, they give us a call first. We're the first one to get a deal in this sector, which is fantastic because when a business that has 20 million ARR is calling us saying, hey, Jesse, can you help us? Our bank's thinking about calling our note, whatever. We actually have access to that proprietary deal flow before anyone else. And that's very, very unique. Like I was at a conference last week and we have a huge deal pipeline and it's all based on reputation in the space. And I think that that niche focus is incredibly helpful. I'm happy to share details about the deals, but the long way to answer your question is we structure them all sorts of different ways. Not a single deal has been the same. Mm-hmm. We've used cash, we use earnouts, but most of our deals are going to be weighted towards a mix of different assets. We actually share with founders, like if you're selling us your business, hey, you want to get like a very high multiple, go sell to private equity. If you want to get a fair multiple and enjoy the next 2 to 3 years of your life, working with actual operators and business owners that have actually built businesses and scaled them, then you should come work with us. And it's going to be a lot more rewarding and enjoyable. That doesn't mean like it's going to work out like from financial or like delivery standpoint or execution standpoint, but it's we'll be in the trenches with you as opposed to 1,000 miles away. I mean, that's a very different model, right? We actually move it. Like our business model is similar to like I think like from what I understand, like Vista and Thoma Bravo, and like originally were embedding themselves into businesses when they buy them. Same thing we operate. We have, we have CTO, we have a chief like business officer that actually scaled businesses. Our CTO, for example, he worked and scaled 3 startups to exit prior to joining. Went to Cornell, computer science. First company sold to Microsoft. Second company was Box.com. He's one of the early first 20 employees there. Leading an engineering team, and then Simon Data joined employee number 9 to help scale that. And then our chief business officer, David, he was employee 9 at Opendoor, was there for a few years helping them scale before they went public. And so like these are folks that outside just myself that actually have scaled businesses as operators, not actually they're not, traditional like investment bankers, and not that there's anything wrong with that. It's a different model. We want to buy businesses and help like embed and help them scale, and then put in a permanent CEO, and then let that business run independently of us. And so that model has been working a lot better because there's a lot more trust there when you're actually be with somebody, from day one, as opposed to, outsider looking in and asking for financial reports and you don't even understand how the business operates. That's not like a great place to be because this sector is very, very niche and very cyclical, right? So I think that's worth calling out. Like every business in this sector has declining revenue in the last 2 years. Just pure, it doesn't matter who you are, other than LinkedIn, actually. LinkedIn's an exception, but they've got a great market share there. So different context.
So 8 acquisitions in a reasonably short period of time. You mentioned your focus is enterprise software. What are the reasons for that? Is it sticky contracts? What else?
Yeah, I think there's a few things. There's a few sectors that have not been consolidated in this sector that have opportunities to be consolidated, or have historically been like left to the wayside. And I'd say that part of that is like part of our thesis right now is that there's a lot of services businesses that remain in the sector that actually be automated with technology. So you can buy 3 or 4 like services businesses, combine them, implement technology that you've built or bought. And now that business that you bought for 3x EBITDA is worth 30x EBITDA because it's now a SaaS company. And you can pipe that revenue directly into the SaaS multiple. So a normal investment banker or a normal private equity fund might turn that 3x multiple into 8 to 10x, right? Just by keeping a services business. We're actually building technology on top. And so that multiple changes drastically. That's part of what we actually offer to we actually sell to a lot of our software to other service providers. One, because they know us and trust us, but we're actually building white label solutions for services companies. One, so we can capture a SaaS multiple ourselves, And then two, you can go to, let's say you run your own recruiting firm, and I could say, hey, why don't you digitize and become a SaaS company yourself? You can white label our solutions. You can become a technology company in the next 6 months. Guess what? Now you have all ARR and your customers are the same and they're buying from you and you have the relationship. A lot of the thing that people forget in this space is a lot of relationship driven sales. And so your customers, I can't just take them as a SaaS company. It's not very easy to do that. But if you go to them and white label our solution, guess what? Now we both have company. You become a software company, your multiples gone up and your gross margin's gone up. And not only that, but you still maintain those relationships and don't get automated out, right? So that's basically our thesis right now. And it's been working quite well, both organically and inorganically from a growth perspective.
You started as a service, but one moment you added SaaS. When did this happen?
In the last 2 years.
Mm-hmm.
Yeah.
And
so
did you build everything in-house, or you bought someone who you saw you could put those things together, or how was the thought process?
Yeah, good question. We bought the software companies, and then we made some tweaks and some action that added some different features and products to them. There's a few announcements coming out in the next month that'll touch on a few of the acquisitions that have not been publicly announced, but we'll be from like that perspective, like depending on how you look at it. It's worth noting, actually, just to like pause for a second, like the HoldCo model of Job Mobz is essentially like recruiter.com. That's that HoldCo. We've spun out a bunch of sidecar funds, like that will basically have other HoldCos for different verticals that they're focused on within recruiting. And so within our HoldCo of recruiter.com, we have recruiter.com Ventures, which is doing all of our acquisitions within that deal flow. And then we'll have other business verticals that we're rolling up within the recruiting space. And like, for example, right now, I think our goal right now, we should be like just recruiter.com itself should be one of the fastest growing SaaS companies here in the world in the next year, with how much revenue we're actually piping through it, in terms of probably hitting close to 100 million ARR. And so our 200 million assets probably will change quite drastically. Hopefully in the next like 6 to 12 months, but we have some pretty big deals closing from a customer acquisition standpoint, not acquiring them, but actually organic growth. And then also both a mix of organic and inorganic growth. So lots going on, but that's the short version of it.
That's awesome. A few more questions about the SaaS strategy. I mean, the multiples of SaaS businesses is, I guess, pretty high when I'm not in SaaS, but when I'm reading, the multiples are crazy compared to, I guess, service type businesses. So how were you able to acquire those, or how were you able to get the reasonable valuations? Yeah.
First off, this is actually my big gripe with folks that sell like courses, right? Like this is not something like I'd sell in a course, like because it makes more money to not sell in a course, right? So if somebody's selling a course about how to make money in a business, probably not a lot of money to be made in that business. But to answer your question, how do we do that? So like, let me think about an industry that's like not giving away our playbook directly. There's a ton of businesses, like think of any business you use daily. A good example would be like, imagine there's a bunch of services businesses that deliver mail, right? The same way like in the US, UPS, or like your mailman like delivers mail. Well, there's companies that digitize that now, right? And like one of them, I'm actually an angel investor in, like Use Stable. Like they're great. They digitize all our mail. They digitize a lot of businesses like mail, right? But imagine in this case, it's a fractured segment, the same way we're treating it. You can go buy 10 or 20 of those mail delivery companies. And then you can immediately digitize it where you don't need any postman or like mailmen to actually go physically deliver it. And you can just send an email with your digitized mail. That's the way services is being automated right now. And everyone is so like scared of the space because of the declining revenue trends. Private equity looks at it and thinks, hey, this business is going to zero. They decline from 10 million to 5 million. Well, that's actually not true. The business is probably just going to stay flat at 4 or 5 million. And you could roll a bunch of those up together, digitize it, and make it instantly a SaaS company with a lot of the things that they're doing. And that whether that opportunity exists across a lot of different industries right now, whether it be manufacturing with like automated like robots and machines, the same way the port strike's happening this week, right? There's a port strike in the US. It's all over social media where they're fighting back, to avoid automation, but that's going to happen across a lot of sectors. And I think that opportunity exists for many of them to buy these historical legacy companies and then implement with technology and solutions. Even if you're not making fully technology companies, tech-enabled services or, automating a lot of the work that's being done internally, there's a huge, huge opportunity for private equity across many sectors. And I think we're going to see that empirically over the next few years, especially with all the money that like private equity is sitting on, right? They're a huge, it was like $250 billion or something in like logjam of capital right now that's just sitting, needs to be deployed in the next 18 or 24 months. I think we're going to see a lot of acquisitions happen here in the next year or two. So definitely exciting times.
So you and your team having this market knowledge, experience, 10 plus years in the industry, how does it make it all work post acquisitions? Maybe the first 30 to 90 days. How do you culturally and how you put it all together?
Yeah, it's a good question. That's probably the integration piece of actually I think a lot of people get carried away in like the financial details of deals. Like obviously price matters a lot, but I think the hardest part about acquisitions is the actual integration piece, right? Like culturally, product wise, especially if you're buying a bunch of software companies, like what tech stack are you using? Are you just going to leave legacy code? Are you going to rebuild it from whatever technology stack you're going to use? There's tons of things to consider. Not to mention time zones and work preferences, all of that, right? So generally our philosophy with these businesses, depending on the type of business and where it fits within our business structure, we'll have a full we start integration prior to even closing a deal, right? We'll have like a full roadmap for like the next 2 years, breaking down into like the first week, the first month, the first quarter, and so on. And you have different objectives and goals for each of those that include both like the tangible things that are very technical, like whether it be like product, transferring everything to AWS or GCE, whatever server we're using, or down to like the cultural elements and the personal elements and benefits and all of that, and making sure that we have cultural alignment. And in all the first smaller acquisitions, we generally let those businesses operate. It's similar to like a Constellation software model where you're basically, we'll put in a business, maybe has 20 people, and we'll just let it run. We'll obviously jump in and we'll help. We might help and do the integration, and we might have one of our team members jump in and lead that as a part-time pick a CEO or COO for 6 months while we hire somebody just to understand that business inside and out. And then we roll them out. But we make it, in that case, know that it's an interim hire, just to understand the business, help operate, and really be a fly on the wall to some degree, and then hire the best person or promote the best person within that business to run that business. And that's assuming the founders aren't staying on, of course. But that's our general thoughts on it. It's really nuanced, right? Because we do so many types of deals. It depends if founders are staying in where the business is at. Is it distressed? Is it a healthy, really healthy, fast growing business? So it really depends on the situation. It's nuanced, but we take integration. I'd say that's like 99% of the deal. Like the financial stuff for me and I think for our team, it's pretty easy. We can generally come to terms. I think a lot of deals are lost actually in how it's going to play out, how it's structured, and how you're going to work together. That's way, way more important, especially for us, because we're actually operating businesses or we're trying to add value to them through our network, through our relationships, through our expertise. And so that's where, deals would, could fall apart more easily than the financial side, I think. So
you've done recently a lot of acquisitions, investments, deals. You started as an operator. Who are you today? Do you consider yourself being still an operator or an investor?
All the above. I mean, I think I still jump on. I still do sales calls for various businesses, mainly because I have lots of friends in the space. Like, hey Jesse, I need help with X. Say, hey, let's chat. I'll talk to them. Like, hey, great. That sounds. I'll pitch whatever it is. Share that information about the product or service, and then I'll introduce them to our team. So I'm still very involved. I lead all product decisions to envision strategy and stuff there. And I think, so I'm quite involved. I try to stay, but not actually operating hands-on, but I work closely with all the business operators and founders of those businesses or CEOs, and try to remain some distance. So I have some semblance of a normal schedule. Otherwise, I'll be working nonstop, Elon Musk style, which would be like 24 hours a day, 365. So I'm close to it, but not quite there. But a lot of my time now is like, my highest and best use is meeting new founders or folks like yourself, and sharing our brand awareness and evangelizing it more. And I think negotiating deals and working with our deal team to close those out. And basically M&A, bankers, and lawyers. That's those would be the three big pillars. But yeah, I'm still pretty hands on with a lot of it, but not as much as I used to be per se.
What are your thoughts about pricing? I mean, you keep acquiring new businesses, you keep growing. Does this give you, obviously it gives you an advantage, but how much can you actually raise prices in this business because of you can help them so much?
So I think that is, first off, like there's a few things, like one, what we pay for pricing compared to others, and then two, like our actual pricing power with these businesses. So a lot of founders will start an HR tech space, which is our space, like generally what it's called. And they'll actually not like, there's businesses where we'll look at them, let's say it's like 5 million EBITDA. And really they want like, let's say 5x on it, but their EBITDA truly is like, or I guess 5 million would even more for a services business, but let's say it's 5 million ARR. But really, the reason it's not 10 million ARR is because their contract actually isn't standard. And so we can go in day one, say, hey, we're going to change all our contracts on renewal or new business. And we can change it to where like, you're going to pay this amount up front. You're going to pay this amount up front quarterly or annually. And they're just not structuring their contracts correct. Like they'd be much better off paying a consultant to come in and look at their like deal flow than selling, because their business is worth twice as much. We're obviously not like share that information, but it's actually showing if any one board of the founders are watching this, go review your contracts, go talk to a sales expert, and like make sure you're actually pricing correctly. That the biggest money that's like see left on the table for every founder that does leave money on the table. And I'm not saying we've had any deals like this, but simply contract, like trying to compete in a space on pricing is like a fool's errand unless you're a big monopoly. And I think I see that way too often where they're not only trying to compete because they can't sell, or in their eyes can't sell. They're trying to compete on price. And I think that's like very silly. So like, if your competitor is, some job board and you're charging $500 a month and everyone else is charging $500 a month and you're charging $400, you're just leaving $100 a month on the table for fun. That's not a differentiator. A company, like, especially in the enterprise or mid-market side, if they're going to pay for a hire, they don't care about the incremental difference of $10,000 annually. They care more so that you actually can deliver on what you're saying. And if you can, they pay twice as much. So I think have a better product or service and charge a fair market price is a much better place to be.
Again, how much you can share? Out of those 8 acquisitions, how many of those have been SaaS and compared to service businesses?
I think the answer is nuanced in that they're technically all software companies now, like in the sense that we've converted all of that revenue to software revenue, like on a recurring basis. So the answer at the time, I'm trying to think of what would be considered what I think of the 8 deals that have closed. I think 3 are software technically at the time of close, and the rest were services. But, and then the 3 that we're closing right now are all software, and every deal we have in our pipeline right now is all software. Mm-hmm. There's no more services in the short term. Yeah, I think that's right. But
and the pricing there, today is the day number 1. Do you raise the prices? What do you do? Do you go through the contracts right away? How does it work?
Yeah, usually like integration, like prior to closing, we'll have a full data room. We'll be looking at things where we think that there's opportunity. We usually don't know fully, like there's usually certain reasons founders, especially if they've operated a business successfully for a long period of time, they're usually not way off, right? It might just be little incremental 5% improvements on different terms. But we'll usually identify and try to rectify like pricing, at least terms, as soon as possible. I think like there's a ton of money. Like the big difference in SaaS, right, would be like if you have a customer and they pay you, let's say, monthly, but they're signing a 12-month deal, right? Why not ask if you can, or at least pressure test the fact that, hey, would they be willing to pay for a quarter up front? Okay, what about 2 quarters? What about the entire year? Or pay it quarterly for the entire year, right? Like, and that way you're actually like the biggest like advantage in SaaS, if you're able to pull it off, is you can get $100,000 AR deal, and you can have it paid today for the next 12 months. Now you're using that new revenue. Instead of having to raise, like, one, you can also be profitable. And 2, like, you use that revenue that you're getting up today for millions of dollars from different customers. And now you can use that to grow. Now you're adding new customers, right? It's just a huge snowball compounding effect. And that's where, like, I think a lot of magic happens in SaaS. A lot of founders are like, oh, just charge monthly. Well, that's not great. Like, if you're end of each month, you're going net 30. A lot of our success has been because we actually started our service business. When we were charging on RPO, we would charge the first and last 3 months up front. So it was a 1-year contract, but you'd pay, say it's $250,000 a month. You pay $1 million up front, and you paid for the last 3 months up front and $1 million, the first month up front. And that helped us move in this trend where we had we're sitting on a pile of cash, where most of our competitors have no cash on their balance sheet, right? They're using lines of credit and everything else. We had no debt, and helped us do that. And SaaS is the perfect model for that, right? So if we're able to charge 4 months up front in a service business, think about this. Every SaaS company has way more pricing power than us. Service business does not have pricing power. Software actually does in a lot of cases, because they don't want to switch. It's painful. There's data loss. It's sticky. Like, there's IT, and like getting those approval processes is not fun. So if you're already there and you can just say, hey, what if we pay like you just quarterly payments up front, really helps with your cash flow, cash conversion cycles, and allows you to grow in a very meaningful way. And I think that's something we look at very thoughtfully.
Again, a question about those acquisitions. When you're looking at the target or the companies you've bought, do you buy because of the product, because of the customers, because of the team and talent? What are the reasons?
Well, I think like right now we're rolling on like a few SPVs, like of different businesses verticals that we didn't actually want to go after in the sector, mainly because of opportunity and it's a mix of factors, right? So I think we look at businesses and verticals. So like right now, like recruiter.com, and we're focused on like payrolling and EOR and different like things there, competing with like many of the other players in that space. And then we look at like, there's a few other verticals that you could go after, like background checks and all like the, testing, advanced testing for candidates. And then like automated recruiting, marketing, and like top of funnel sourcing. So those are like the 3 like verticals we're looking at. I think, I pause there. I'm happy to dive into any of those more in depth. But that's kind of what we look at it by segment more so than the exact price per se.
Now a bit more general question. You are very focused on one vertical, but there are many other holding companies which are like sector agnostic. What are your thoughts about this, and maybe advantages, disadvantages, if any?
Yeah, totally. I'll answer that. By the way, to answer your question on like pricing, like we'll buy a business just to like go in this, like it's just like a house, right? So because we understand this space, like the sector so well, if my neighborhood is a bunch of homes that are $500,000, right? And now my neighbor is like, I don't really want to buy in my neighborhood. I'm investing somewhere else. And it's like $250,000 a house. But my neighbor down the street is willing to sell me their house for $300,000. You best believe I'm going to do whatever it takes to figure out how to buy that house, because I get a $200,000 arbitrage. That's how we feel about our space. So like in a lot of cases, founders will come to us because they believe in the long-term vision of like what we can do, where you can roll some equity, go tuck in, so we can start a platform, right? So we can start a platform for this sector. Background checks, or EOR, whatever, and then we can tuck in 5 other companies, and now we can make one of the market leaders in that category. And now we have a business that's worth $250,000,000. And we're doing that quite commonly now, and we've proven this out where founders have a lot of trust and confidence in that. Where we're getting deals 50% of what they're like somewhere between 35 and 50% less than private equity you'd have to pay directly. We don't consider ourselves private equity, and that like direct, technically we are, but because we're bootstrapped for the time being, that's technically who we run into more than like strategics. So, yeah.
What are the key operational challenges today you and your team is facing when managing it all?
Did you want me to talk about this? I didn't talk about the other, like why we don't invest in other sectors.
Okay, go first, yes.
Yeah, so like the reason we don't, I think there's like, we actually get deal flow for other sectors. I think part of that, like, is just, I think we'll probably expand there eventually in the future. Like, if we open a fund, I think in the future and actually raise LP capital, I think we'd probably look elsewhere. Once we've consolidated a lot of this space, I think right now in the short term, like we want to stay with where we're experts in. And I think we eventually expand like enterprise SaaS. It's more like touching different parts of, enterprises outside of just HR and recruiting. So that would be the short answer. But
okay. Enterprise software, very attractive for investors, for business builders, as well for recruitment businesses. How much competition there is, and what are your thoughts on this?
Definitely competitive. I think the sector matters more. I think that like if you're going to compete with like, I think you need to have some advantage, like whether it be like go to market or customer, like either build the best product, right? You either have to just destroy the product category, which is very hard to do, or you have unique relationships and insights into different parts of the sector that you can make a lot of money in niches, where there's lots of winners, like your payroll, right? Where you can have tons of companies that make there's a ton of publicly traded companies that are worth billions of dollars, right? Think about ADP and Paychex and Paycor and Paylocity. Those are all publicly traded companies, and what do they all do? They all do payroll. Everyone uses payroll. It's universally true. Like tons of companies. That doesn't include the private sector ones, right? We think about remote.com, Deal, and Rippling, and there's just a bunch of amazing companies in that sector. And so that's like something that like you don't need to have the best product. You just need to have a good amount of market share and have a niche focus in that sector to win. So I think that's like the one thing. I think if I was trying to I think it'd be much harder to go build like a CRM and compete with like LinkedIn. That would be something that would be like very red ocean strategy versus blue ocean strategy in terms of building products and companies that win. So I want things that like either can have complete like market dominance, a niche, right? Where maybe we're supporting some niche category. Like if I was just doing a business that does software for dentists, right? If you're doing dentist hiring software, and I'm not talking about anyone, just a random example, that would be an interesting company to us. Because like, cool, that's a winner, right? In their sector. They might have market share, but they might only have 5 or 10 million ARR. It's not the whole market. Like the whole TAM is only like 15, right? So they own 30% of the market, and we'll buy that business and let it run and operate. And that's great. Just generates cash flow. We can run it up like efficiently, maybe expand into some other relationships we have with other, insurance companies or whatever, and in things that are ancillary to that. But I think the point being is we want either market winners, the best product, or a niche market, or something that has a lot of bifurcation in lots of winners in that space.
Few questions about the market, and for the next 5 years, you made a post on Twitter that you were filtering Y Combinator companies, and there were 0 recruiting SaaS companies. What are your thoughts on this? And what might be the reason that there is a 0 recruiting SaaS companies?
Well, yeah, definitely a cyclical market, right? So I think you'll see this in recruiting every time there's a down sector. Like it's similar to any market that has lots of like cyclical nature. Like you see this in 2008, you see this in 2000 with recruiting, right? Lots of recruiters became like real estate agents and moved into different careers. You're obviously seeing that right now, where the market's been really, really bad. In fact, one of the more interesting things, I actually called out the BLS job report. So I said the jobs numbers were actually wrong in the spring and the summer, saying they're way off, like unemployment data trends that we're seeing. I called that out, and that was before the before the Bureau of Labor Statistics for jobs in the US revised all of their March of 2023 to 2024 job forecasts down like 1.5 million jobs. Because I said the numbers weren't basically matching up. And so we have like, I guess it's a way of saying like we understand market trends. And for us, it makes sense because we understand these businesses. We know when they've stabilized or what customers we can implement their software into. So we can buy a business that historically trades at, let's say it's 5x earnings, whether it be EBITDA or ARR. And we can buy it at, like I said, a discount, like 2.5, 3. And we know that long term, it'll trade at closer to 5 to 6, right? And that the market's going to come back pretty heavily. And when it does, the revenue's down half, right? So we're paying half on a half down. Like, so if normally they're making 10, now they're making 5, and we're paying, a multiple on 3 or something like that. Essentially, we know that this business should return somewhere like their revenue should go up 50%. We're buying well below like normal industry standards, and the actual trading number should go up. So if like they're trading at, a simple example would be 5 million ARR, revenue's down 50%. We buy them at 15 million. And now the revenue goes to 10 and the multiple goes up because the market's up. Now we can sell that same business for 50 million. That's a huge delta, in 2 to 3 years. And I think that's where the market goes in the next 5 years, somewhere in that direction. Back to historical like hiring volumes and general costs. And that's going to have to happen, by the way. So you look at like enterprise customers right now in the space, the largest companies in the world, they've reduced like recruiting spend 90%, 75 to 90%. That's off historical like norms, right? They cut everybody. There's no one there. So when they need to hire again, they're going to need services. They're going to need vendors. They're going to need software. They're going to need a lot of it. It's going to be all at once. So you could have another huge spike, here in, short order if things were to flip, or the Fed ever cuts rates to 0 or does a huge cut more than a couple basis points.
So we have talked a lot about recruiting businesses, recruiting industry. It would be dumb for me not to ask like some general questions about business entrepreneurship and how you do it all. So I want to go back to those early days when you worked next to those founders of now, some of them many billion-dollar companies. What was the advice, or what were the lessons you learned from those people? Because not everyone has a chance to do that. Not everyone has a chance to be around those people. So what did you see that maybe others have not been able to see? Because these were still early days. Some of them have 30 employees, 50, 100. Today they have thousands.
Yeah, I think even today, even founders that didn't work with, one of the things that stands out lessons wise is those folks are always really quick to respond. Like I hadn't talked to one of the founders and one of those founders of one of those companies in a few years. And I texted them on a weekend, and they respond back in 10 minutes, right? Like it's actually like a really, they're, even though they're billionaire, multi-billionaire, they're still responding in 10 minutes to somebody they worked with a few years ago. That's, pretty incredible. I think that's the one thing, lesson wise, that those folks are always on. It's just, maybe it's just how they're wired to some extent. And I'm similar that way myself, very competitive, type A. And I think, whether you play team sports or individual sports, I think a lot of that, flows through. A lot of those folks have in common, they were elite at something, right? They're elite at mathematics. They're elite at biology. They're elite sports, whatever it is, gaming, chess, they're very competitive at something and they're very good at it, whatever that is, right? And I think you see that intense focus. You can have a founder that's amazing. I wouldn't want to go compete with Elon to go build electric vehicles. It's just not something I'd want to do. Could I do it? Maybe, but I think there's plenty. You need to be really good at what the thing is, and that's why I think our fund being focused on recruiting is very much a strategic advantage, because that's something we're an expert at, right? If I was going to go buy very hard tech or hardware, manufacturing companies or something like that, that's very high OpEx, I would absolutely get my teeth kicked in, right? So I think that they have a passion, right? They know something very in depth and they go all in on it and they become the experts at that. And so I think that's something that they all uniquely did, right? Whether it be crypto or fintech or DNA or whatever the case may be. So, yeah, I think that's the big lesson there.
And on your personal journey, what have been maybe some of the mistakes you've made or some of the biggest challenges you've had, because you've now seen different cycles because you've been in this for such a long time?
Yeah, I mean, I think the biggest one, like many founders, I think quit too early, right? I think like even for us, if I look back and like played like at the time we got many acquisition offers, right, throughout the years. Like I had my first acquisition offer in 2017. Would have made $500,000 in cash, right? Like it was a pretty good amount of money for me at the time. Wouldn't be life changing, but almost like an acqui-hire, decent cash at close with another, really like rich salary and everything else. That didn't go forward for many reasons. But we were supposed to sign, like we were at the day of signing and it backed out. Like, so like, which is like very like fortunate, in hindsight. And then like, again, I think at the end of 2020, like we had another offer again. I almost did. We had one in 21, 22, like every milestone at the time, you want these off, like as a founder, like you either like you're tired, I think that, the common theme for founders is like, you're tired, you've worked a long time, you have imposter syndrome, all those things are true. It changes at scale, right? So like going from like, your first year or two, you're like, oh man, I can't do whatever this is. Maybe you think about it once a week or once a day. But like as you scale, you still think about it, right? Even in the current state, it's like, oh man, what am I doing? I'm running this huge company. Can I do it? But it might be once a month, right? And I think that like, well, too many founders quit before it gets really good or sell before it gets too good. And I think that, and I actually don't fault them, by the way. I think that it depends on your life circumstances. I was very fortunate to also maybe be lucky or good at investing outside of that. And I started real estate investing. I did pretty well with that, buying undervalued homes at the time back in like 2018, 19. And so I didn't need to sell since then, right? So for many reasons. And so I think if you need money though, like definitely like the first one, I think better to sell quickly and get that first that first liquidity event allows you to go shoot for the moon the next time. So I think that's worth noting. But yeah, you don't quit early if you can avoid it. My best advice: go long.
When it got good for you, you mentioned founders quitting too early. When it got good for you that you woke up in the morning, even though a lot were going on, you were like, things are good. We all know this feeling. So when was it for you? I am very intrinsically motivated. Like I don't care about the money. I like winning, right? So like for me, when I do things, I want to win, mm-hmm. right? The money comes secondary to me. Like yes, of course, if I have shareholders and folks that I want to make money for, but us winning is paramount above all that. Like that's what gets me inspired. Like going to work for our customers, going to like, talk to our like employees, and stuff like that. That's more like intrinsically motivating for me, in winning and inspiring others to help us win. Because then, I can't do it alone. And I think that part, to me is more empowering than money alone. I think it was just a money game. Like I could go sell tomorrow and don't have to go lay on the beach, but I don't like the beach more than like 3 or 4 days and I'm tired of it. So like, so I think, that's the part, but to answer your question, I think like, I don't, the bar moves, right? Mm-hmm. So even like our current size, right? There's not a day where I wake up and like, oh man, I made it, right? It's like, oh man, I have this other goal, right? The goal moves, generally speaking, upward. So I think that there's, I probably get it more from others now where like, hey man, like congrats, folks that'll hear about something or read an article and I'll get it from others. And that's like a moment of reflection, like where I'll be like, oh wow, that's like, it's cool. I didn't realize that article was published or whatever the case may be. And that's where probably like the more realization comes from. Like, I don't like stop and like, there's no moment where I'm like, oh, I pinch myself. I'm like, oh man, we built this cool company. For me, I'm just looking at the next step. How do we get to that next goal? How do we achieve that next deal? Or build that game changing product. So that's where my mind's at. You being someone who constantly wants to win, are you easy to work with?
Probably not. I'm pretty self-aware. I think like I'm very upfront about it. So I think the thing that I'm well aware of is like, I think that I'm self-aware in the sense that I can tell you what the pros and cons are. Like, we're doing this podcast. It's 1:45 in the morning, right? I work super late. I start at 9, work till like 5, and I'm jump back online and work every night till like 12 or 1 because I like it, not because of the money and not because I have to. No one would be the wiser if I was out, but I think definitely difficult to work for a place in the sense that like, I'd say that if you're the type of person that needs daily encouragement and feedback and not like that you can't work autonomously, you should definitely not work with me. That'd be very difficult for you. But if you're independent and autonomous, and you can deliver on results with like, hey, I'll give you the North Star, the vision, the goals, and you can go deliver on it. That's not to say you wouldn't have help. I think that, everyone, huge support staff, huge team can call me. I'll call folks back pretty much anytime between 9 a.m. and literally 1 a.m. So I think the point being is that it's great for the right person and not great for the wrong person. And that's great because I think like it's binary in that like people that do not fit that culture, they can't work like hard we need to and want to work a normal 9 to 5 on our leadership team, they just opt out before joining. And it doesn't really impact our employees because, they're running those businesses day to day. And like we tell folks, actually, one of the things that we're pretty transparent about is like, we prefer you to set your schedule and you can work whatever hours you want, so long as it fits your customer schedule. We'd prefer you go to your kid's soccer game or birthday party, whatever it is. We want you to actually have that work-life balance. I think it's different on the leadership side where we're pushing the puck years down the road forward. And I think there's a lot of autonomy and opportunity for folks that want to like make a name for themselves and do well.
So
it's probably difficult to work with to some extent for some folks, and not so much for others. But yeah,
few more questions. It's 1:45 a.m. Pacific time. When we booked this call, I said to you, man, are you sure? Because it's very late. You said, yeah, totally fine. That's how I perform. So how do you do it? Family-wise, friends-wise, sleep-wise? For how long have you been doing it? Do you take breaks quarterly, monthly? How does it work?
I don't think I've ever like had a true vacation in the sense that like I've taken plenty of time off, like, but like I'm always plugged into something, right? There's no like disconnecting. But I think my general schedule for folks that are curious, I think is like I'll work normal business hours, call it 9 to 4 or 5. I get off, I hang out with my kids, with my wife, and until they go to sleep, usually around like 9:30, 10, I'll jump back online for a couple hours. And that's pretty standard, for as long as I can remember. So yeah, it hasn't changed much. And I'm always been more of a night person than like, if you're like, hey, going to this 8 or 9 a.m., it's not interested. It's not my, part of my, normal schedule, honestly. So I think that's it. And vacations, I actually do some of my best work on my vacations. It's actually quite like counterintuitive. So I'll go on vacation. I'll have nothing on my calendar. And then I'll think of something like, oh my goodness, I got to text Mick about this thing because I saw on Twitter that he had this guest that has this business that I want to buy. And things like that happen when I'm on vacation because I have time to just think for like a week. There's nothing on my calendar that's structured that pulls me in a different direction. And so generally, my team's pretty stoked when I come back because I usually have something that's a huge opportunity, whether it be M&A or a business customer that I was able to catch up with while it's gone. So that's free thinking time. I think whatever like founders or investors or whoever, like if you have time, whether it's like in the shower, going for a walk, going on a break, like that free time is where like the best like things happen in my experience. And I think that for me, that's like actually just taking a day or two off and just like completely disconnecting from work, from a schedule, like a routine perspective. And so it's actually really, really beneficial. So anyways, we go on lots. I go on plenty of vacation, long story short, but usually plugged in, not as opposed to disconnected like you might expect from other folks more traditionally. So,
okay, a question I'm asking from every guest: how has entrepreneurship and building your businesses changed your life and changed your family life?
Yeah, I mean, it's definitely changed my life for the better. It's been really rewarding. Got amazing. I think it's exceeded my wildest expectations in terms of my career. What I set out to achieve what you told me when I was 22 when I started business. Where we'd be today, I would probably laugh at your joke messing with me, right? So I think it's exceeded my wildest dreams. It's been an awesome journey. I think we're only part of the way there. Still plenty of years left and lots of things I want to accomplish. So, like I said, money aside, I think there's just lots of goals that we want to accomplish on the business side and product and customer standpoint. And then from a family perspective, it's fantastic. I can work my own schedule. I coach my daughter's soccer team. I volunteer and do lots of things in the community. And so overall, it's been amazing, right? Like I don't have a boss, right? Like no one can say, hey, Jesse, you have to be at work at 9 a.m. It's like, well, I'm not going to that meeting because I'm going to my kids, drop my kids off to school or whatever it is. I can move my schedule in any direction, which is amazing and really rewarded. So I couldn't recommend entrepreneurship, even if you're making, I would be an entrepreneur, even if I made 25K a year. I don't care about the money. I really just care about like the mission and the lifestyle it's able to provide for you and your family, your friends, whatever is important to you. I think entrepreneurship, you can align with that pretty spot on, which is, I think, amazing.
Let's wrap up with the famous five. How old are you?
Actually, it's probably I think it's up there. Blue book 0 to 1. It's up there. Peter Thiel. It's my favorite book.
Married, single, kids.
Married,
single, kids.
I'm married. I have 2 daughters and 2 dogs that are terriers. So golden doodle and a terrier. So.
What car do you drive?
This is actually funny. I get this. People don't believe me. I drive like a 2023 Toyota Camry. That's it. I'm incognito when I drive.
What's the best investment advice you've ever got?
I think that think about investments from like expected value, right? So like everything's an expected value. What's like the range of outcome, and then level set based on that, right? So if you like the neighborhood example I gave earlier, where the homes are normally 500K, you can buy them for 300. Find deals like that, whether it be a business, real estate. Like you can't go wrong when you have a huge wedge or like buffer on the deal, unless you just completely buy outside of your wheelbox. I think that's the best, and those deals are everywhere, right? Like you can go to your local market and find a deal for something that's way underpriced. There's no appropriate, especially buying businesses. There's no like the pricing, there's not an efficient market in a lot of cases. So there's tons of mispricing. And I think you can find opportunities if you look hard enough.
Okay, the last one. As you're so humble with everything you've achieved and the numbers you shared before the call, I'm not even mentioning those. It's unreal. I'm sure few people will want to reach out to you. Where can people find you?
Yeah, you can find me on Twitter. It's just at Jesse Tinsley, first and last name, or on LinkedIn, same name, and I post on there quite frequently. So either place.
Okay. Again, thanks a lot for doing this, and I can say good night.
Awesome.